So what we want to talk about today for Anthony is a quick look at covered combinations. What is it, when to use it, and the pros and cons of the basic structure. Anthony's direct question would be, when would it be appropriate to use a covered combo strategy, and how far out would you set the trade? Okay, pretty basic. What is a covered combination? Essentially, a covered combination is setting up an at or out of the money covered call. Buy shares of stock, sell an at or out of the money call just as you would in a covered call position, gives you some room for upside growth, generates income to lower the cost basis. At the same time, you're going to sell an out of the money naked put to potentially accumulate more stock at a lower price. This is done on the same stock, typically with the same expiration date. To keep it simple, but you can use other combinations. So we're going to buy stock, sell an at or out of the money call, and at the same time, sell an out of the money put. That's your covered combination. When to use it? Well, let's say you're interested in holding a stock long term. It typically trades in a range. You don't mind accumulating more stock in your portfolio for the long-term hold, and maybe you don't mind being assigned if the stock moves up above the call side and you hit the maximum profit. Likely you're going to plan on rolling that short call to avoid assignment if it is a long-term hold. This is an example. It's not a direct recommendation or suggestion, but Ally is a good dividend-paying stock that has been strong but has also had weakness. In the last 3 months, it's ranged from, about 52 up to about 55 or so, but it has had some points where it's dropped down below 50, down to say 48, 47.50 in that range as well. But long term, it's a good financial stock, maybe not the best one, maybe something like JPM, Citi might be a little bit better, but it's a good stock, pays a nice dividend, lowish price, which may become important. What is the structure that I would set up today for a covered combination on Ally? Well, we want to own the stock, get income to reduce costs, and potentially accumulate at a lower price. I'm going to buy shares of Ally around 53.45. We're going to sell the 1 month out. We're going to look at the September out of the money 55 call for 72 cents a premium. And at the same time, I'm going to sell a 1 month out 50 put. Ooh, sorry about that. That's going to be a 50 strike put for 36 cents. So the cost per share, we're essentially generating 108 in premium. So we're going to lower this down to 52.37, the cost basis of our position. Not exactly. This is a covered call with a naked put. Owning the shares of stock or the covered call position does not cover the obligation of that naked put requirement. So I am putting out 53.45 for the stock. I am generating 108 in premium. So essentially that cost out is 52.37, but I have to put up another $50 per contract to cover the obligation of the naked put. So my total monetary requirement would be the cost into the stock plus the margin requirement for the put. I'm essentially doubling my cost basis at this instant of what I have allocated to the covered combination. But again, we still have a max profit of $263 against that $10,237. So it's still a 2.6% max return if assigned on the trade. Now, what are the outcomes? Okay, I won't say the best outcome, but the potential outcome of the stock staying between the strike prices is the least amount of work. Your call and put expire worthless. We keep that 108 premium, so now we are down to just a cost basis on our 100 shares of 52.37. We had no obligation to do anything else. Now I can simply enter a new covered combo for the next month. I could maybe sell the same 55 October call and the 50 October put, or use a different combination depending on exactly where the stock is and what strike prices are available. So easy outcome, stays between the strikes. Our call and put expire worthless. We have the shares. We re-bracket the position for the next expiration or the next month out. Outcome number 2, the stock rises, goes above our sold call position. Our put expires worthless. It's out of the money, but just like a covered call, we may be facing assignment at the short call strike price. This does represent the max profit on the trade. But if this was a long-term hold or a long-term plan, Anthony, we'd probably roll up that call just as we would with a covered call. Buy back the September 55, maybe roll to an October 57.50 or an October 60 strike, depending on where the stock is. We would keep the trade going. It's a long-term hold. If we just wanted to use the covered combination for premium, then we might just get assigned and look for a new covered combination. You could approach it that way too. But in general, when you do this, it's likely that you're looking for a longer term hold to generate near twice the income as you would with just the covered call, with the potential to accumulate more shares of stock for a longer term holding. Speaking of accumulating more shares, outcome number 3, the stock falls below the sold put strike price. In our example, it falls below 50, Ally's trading at 49. The call expires worthless, just as a covered call would that remains out of the money. We still have 100 shares of stock, but now we may be obligated to buy another 100 shares of stock at $50, the put strike price, just like a naked put that goes in the money. Now, I have a nice average cost per share. Effectively, because I kept that $1.08 premium, the cost on my initial 100 shares is $52.37. I'm adding another 100 shares at 50, so now I have 200 shares with a cost basis of about $51.19. Now, I can do a covered combination for the next month on 200 shares. Stock stays at 49, I might sell 250 calls and sell 247.5 puts. Again, rebracketing the covered combination. Or to avoid assignment, we could buy to close the 50 put, roll it down to the 47.5, and then sell the 50 call for October. You could roll down both legs, or you could just take assignment for the accumulation. Basics, what are the pros and cons of the covered combination? Well, the pros are it increases income over the standard out-of-the-money covered call or out-of-the-money naked put. We're getting 2 premiums. We can accumulate shares for a long-term hold on the position. We can still get dividends. There's nothing in this trade that would stop us from getting dividends or having to pay dividends. And long-term, we can continue to reduce the cost basis with 2 income-generating approaches. That covered call and the naked put is our covered combination. The cons, it's near double the monetary requirement of just a covered call position. I have to buy the stock, do the covered call, but also put up the margin requirement for the naked put. There is no downside protection beyond the premium received. If for whatever reason, Ally dropped 10%, well, I still collected $1.08, so we got that 2%, but almost 3%, excuse me. But if the stock falls 10%, I take that 2.6% into account. I'm losing 7.4% on the covered call, and I'm also losing probably 4 or 5% on the naked put. The losses start to pile up quickly as it falls. Now, your goal is accumulation, most likely, so you don't mind if there's certain ranges where the stock falls 7, 8, 10%, you buy 100 shares, average down, and then you're doing twice as many covered combinations. But that can also get expensive. In the case that the stock fell below the short put strike price, in our example for Ally, and I got assigned at 50, I now have 200 shares. So I've got still about $10,000 into this position on just the stock. But now I'm going to sell 2 47.5 puts at 47.5 or at 50. That's another $10,000 monetary requirement. And if I get put again, I now have 400 shares with an average cost basis, let's say, of $50.80, but I'd be selling 4 puts at, say, 47.5. That's another $16,000 roughly I've got into the position. It can add up quickly, so you have to plan it out based on your structure, based on your account size. When do you stop? When do you stop accumulating? When is enough for what your plan was for this position? Now, this is just the basics. We just wanted to review the basics there in that case. For Anthony, the covered combination, own stock, selling at or out of the money call, selling out of the money put, usually just 30 days out in time. Same expiration normally, same stock. But it can be done multiple ways. I could sell an at-the-money call and an at-the-money put for higher premium, understanding that at some point I'm going to have to roll or accept assignment on the call side or the put side because it's going to move away from that. You could sell an in-the-money put and a further out-of-the-money call trying to force assignment. So I start at 55 and then of course, 55 put, excuse me, and maybe the 57.5 call and hoping to be assigned at 55. Maybe just buy 200 shares of stock at that point, depending on the premiums. Of course, you could sell a 1 month out call and then sell a leap put for more premium. 12 months out, just have the money on that side for that accumulation. Or you could sell a leap call and sell a 1 month out put if you feel the market's going to be fluctuating and you might want to add at a lower cost basis during the volatility, but you think things are going to smooth out further down the road. You could just use leaps, period, for more premium up front and then turn the blind eye to the position for a couple months unless there's a lot of fluctuation. Of course, you can use weekly if premiums are good and it matches your trading plan. So that's just a basic review on the covered combinations. Of course, with the covered combination strategy, you can use the power options tools, excuse me, just as you can for any strategy. Search for positions using our defaults for the covered combo strategy or set your own. Look for positions one stock at a time with the search by symbol or build the covered combinations using the custom spread tool. You can track positions in the portfolio tool just like you can with any other strategy. And of course, evaluate rollout opportunities for the short call or the short put, depending of what your expectations are going forward.